That's a very popular one in our world and very well attended. So spread the word and look for the invite. I want to introduce our team. Steve Connard, raise your hand. Steve here. Michelle Bjorken. Caleb Pearson running our IT stuff. Thank you. Alan Holstein. Thanks for coming. Justin Van Houten. All right. And also our other team members, Julie Greer, Nancy Economist, Hannah Mason, Cheryl Hurst, and Joe Waniger. Thank you. All right. Today, this is an event on how to inherit. And the reason I titled it that is because there's a lot of information out there about the generation that's trying to pass their assets on to the next generation. That's called estate planning. But not a lot of information out there for the generation that is inheriting that. And of course, we see that and have that question a lot with our clients about what does this mean for me? So I decided to create this presentation to talk to that generation. Okay, so first thing is how to inherit. Asterisk. There's a lot of asterisks in this. It all depends on how it was owned and what type of property it is. So it depends. How to inherit. Asterisk. Different types of property are owned and passed in different ways with different tax consequences. And we're going to work through property type by property type to show you how to inherit. Disclaimer, here's my disclaimer. And by the way, I need to make an introduction here too. I am not an attorney, and this is not legal advice. We will be talking about a lot of legal concepts. We will be talking about a lot of financial concepts, but this is not advice. I am also not a CPA, and this is not tax advice, but I do have a good friend of Compass here, John Marshall. He is from McGowan Hurst Clark & Smith. It's really the largest locally owned CPA firm in Iowa and probably in Des Moines. And it is right across the interstate on the backside of Farm Bureau building. Okay, that's where they're located. John and I have been professionally associated with each other for a long time. And now I'm coaching his kid. So we got another connection here. So John Marshall is going to be piping in from time to time. He's going to be available for questions. I would say hold your questions to the end. I got a lot of information to cover, and we're going to go pretty quick to leave some time at the end for questions. So John, thank you for being here. Okay, the first thing I want to touch about inheritance is it's not all about money. It's not even mostly about money. When we talk about the big concept of inheritance, think about all the things that you inherited from your parents, right? I look in the mirror every single day and I think, oh my goodness, I'm turning into my father. That's all I see. I've even inherited some of his mannerisms. And that's a day of reckoning when you realize that you're turning into one of your parents, right? You may have inherited something bad from your parents, like heart disease or a history of diabetes, or there's all sorts of things. So think about all the things that you've inherited, because when it just becomes about money, it gets empty pretty quickly, okay? There are essentially 6 ways to inherit property, and we're going to touch on each one of these, both in a practical sense and in a tax ramification. You can be a listed beneficiary. So there is certain assets that are only passed through a beneficiary designation. The beneficiary designation is a piece of paper that has names listed on it about who gets this particular property when someone passes away. There's joint ownership. Okay? You can own something with someone else. You can be named on a transfer on death or payable on death instruction. We're going to talk about that. You can be the beneficiary of a will. Intestate succession means if you can be related to somebody who doesn't have a will, and the state of Iowa has rules, has a law for how that property passes, okay? Or you can be the beneficiary of a trust. These are the only ways that people can inherit property. And we're going to talk about all the different types of property that work in each manner. Okay, all this stuff was at the end, and this is all the important stuff, so I just moved it to the beginning. There are inheritance fallout we see. In fact, some estate attorneys that are helping estates wrap up and distribute property call themselves divorce attorneys for the next generation. Now, how many people, how many parents would be happy to hear that said about the generation that you're passing your assets to? My guess would be this is a very disappointing point for a lot of people that would be rolling in their grave because their kids are fighting over the inheritance, or fighting because it wasn't fair, or fighting because I didn't get grandpa's lucky penny, right? So very disappointing, but this happens a lot. And like I said, it's usually the small stuff that causes the most problems. Who gets the plates? Who gets the piece of artwork that hung over grandma's sink for 55 years, right? These are the things that cause a lot of problems. Okay. Oh dear. Lost my battery. Okay. A recommendation. Take some time to ask about your parents' estate plan. Got it? Okay. Ask your parents. Ask the generation that you're listed as beneficiary, what do you have in place? We don't have to talk specific numbers, but I got to know that you do have something in place to keep us kids from fighting about it. Okay? Go back to the prior point. Don't let your estate plan or your parents' estate plan cause problems between you and your siblings. Help them get it figured out. Ask about an I love you folder. This is a folder that has everything in it. If the prior generation would happen to pass away, that you know where it's at, it's got the contacts, who's your parents' CPA, who's your parents' attorney, who's your parents' financial advisor, who's named as executor in your will. Where is your will? Where do they bank? Where's their bank account? Warren Buffett, great advice. He says, do it now while the generation that owns the assets can still make changes. Because we're going to talk about some major mistakes that happen even out of people's best intentions. Okay, major mistakes that can be avoided if you do it now and go get some professional advice on how it's done. Common questions that we get as financial advisors from those inheriting: is this taxable? Do I owe any taxes on this? The biggest question. Number two, what does this inheritance mean for me financially? And I will tell you there's some psychology there, because if the inheritance is large, there could be some guilt. Like, boy, you know, this is my parents' money. This is not my money, or this is my grandparents' money. You know, what do I do with it? How do I treat it? Can I use some of it? All those things come into play. And so over time, I can tell you that our advice to people inheriting is you need to find a way to fit this money into your own financial plan and make it yours, okay? And all the while being wise with it and honoring the generation that came before. From the parent generation, we hear the question, how are my kids going to handle inherited wealth? That's a huge question. And you know what my answer is? How are your children building and handling their own wealth right now? Because that is the best indication about how they're going to handle any wealth that's passed along to them. Okay, again, parting shots. This was the last screen I was going to talk about, but it's so important we moved it up. Inheriting means something sad has happened. So oftentimes, you want to let things sit for a while. Don't make immediate decisions. Don't just let it sit. Don't make big decisions out of grief. Okay, this happens a lot with spouses, right? If you lose your spouse, a lot of grief there. Don't want to be making big decisions right in the moment. Sometimes you're forced to, oftentimes you're not forced to right away. And like I talked about, inheritance is so much richer than just the assets. When people talk about what they're passing along to the next generation, money is often at the bottom of the list, okay? But it is a necessity that needs to be dealt with. Also, money is a magnifier. Think about your kids. Same thing. If you're a saint, or if you're an angel and you get a bunch of money in inheritance, you're going to be a saint. If you're a jerk and you get a bunch of money in inheritance, you're going to end up being a super jerk. That's just the way it is. It magnifies the good and the bad. Okay, here's a spoiler. We're going to hit on this a couple times throughout this. Under the current law, now we're getting down to kind of the facts and the nitty-gritty of how all this stuff works. Under current law, the most tax-efficient way to inherit, remember, I'm looking at the inheriting generation, so the most tax-efficient way to inherit is at the owner's death due to something called a step-up in basis. And we're going to spend a little time defining that here in a moment. John, would you agree with this?
100%.
Okay. Hey, by the way, Mike, because those online.
Okay. Yeah, 100%. As long as, if you hear the terms like gift tax or estate exclusion and stuff, those are all things that are kind of in the same mold. So as long as our current system allows for a step up in basis to fair market value at death, this is the most tax efficient way to transfer wealth, assuming you're not uber wealthy, someone that's worth hundreds of millions of dollars.
Well, even so, they still get some step up in basis.
Correct.
Right.
But there could be tax on
That's
these.
right.
Correct.
Okay.
So if you're,
Let's keep going. Okay, 6 ways to inherit. Be a listed beneficiary. Joint ownership, talked about these. POD, beneficiary of a will, intestate succession, and beneficiary of a trust. We're going to start looking at the top, okay? Listed beneficiary. There are four assets that have listed beneficiaries. Again, a piece of paper determines where this money goes. Retirement accounts. By the way, all retirement accounts have beneficiary designations. Life insurance. All life insurance has beneficiary designation. Pension plans have beneficiary designation. Annuities. Okay? Beneficiary designations, that piece of paper is the only way that these assets get passed to the next generation. And by the way, whatever is on that beneficiary designation, that is exactly what's going to happen, no matter what your will says, because your will governs other property. And we will talk about that. Okay, there's several types of beneficiaries. You can be a primary beneficiary, which is the first person it goes to, or the first series of people it goes to. Or you can be a contingent, which of course is the next, if none of the primary beneficiaries are still alive. Okay? Spouse is typically the primary, unless you're single.
pipe up here 1 second. If you are remarried, look at your, and it's been a long time since you looked at your documentation, your original spouse may still be on there. I've had instances where 20 years went by and the first spouse was still listed as the primary beneficiary. It goes to the ex, regardless of who they were married to at the end.
Bad news, there's court cases like that. There was one out in New Jersey years ago. A guy started working 18 on the factory floor in New Jersey, right out of high school, married his high school sweetheart, worked his way up to CEO by the time he retired. The year after he retired, he passed away. And in the meantime, he had gotten divorced from his first wife, married to his second wife, had his family, celebrated his 40, year anniversary, and passed away with a 7-figure 401k. Who was a listed beneficiary? First wife. Got it. $1 million. Beneficiary designations really matter. Okay? Again, often spouse is the primary, and often if your spouse is alive, kids are typically contingent, right? So if the spouse is gone by the time you pass away, it gets passed to your kids. Now there's 2 special designations I want to talk about. It's called pro rata and per stirpes. And let me show you what happens. So this is after someone's spouse has passed away. Old Jane now is a single owner. She's been widowed for many years. And so she's a single owner of this property. And she listed her 4 kids as primary beneficiary at 25% each. Pro rata, right? Prorate means 25 each. Well, 2 of them have predeceased her. 2 of them are already dead when she passes away. So those portions get, well, the whole account gets filtered out with the remaining alive primary beneficiaries. So in this case, Alan and Beth would each get 50% of that account. Okay? If you would choose a per stirpes designation, per stirpes is actually Latin for root, kind of like lineage. So again, single owner, 4 kids as primary beneficiary at 25% each. Per root or lineage, look at Charles's 25%. Gets split between his 3 kids. It goes down instead of staying at the primary beneficiary designation. Denise's 25% gets split between her 2 children. Okay, so there is a pro rata and a per stirpes designation on beneficiaries, just so you know. Okay, now we're going to talk about taxes on retirement accounts. This generates the most questions because it's the most complex. There's tons of rules. It depends on your age, the beneficiary's age, all sorts of things, and it's changed recently. And I would say lean on your advisor for this because, again, this generates, and it's actually the most common. It's the most common to inherit a retirement account because many of us, most of us have some sort of retirement savings. Okay, taxes for beneficiaries. On tax-deferred accounts, right, pre-tax money, distributions are typically taxable to the beneficiary, which is actually the same as the original owner. Okay, when if you were to have a 401k and you took it out, you'd pay tax on that money, right? Same thing with your kids. So you basically inherit the tax status and the tax ramifications of the prior owner. Very simply. Same thing. But Roth accounts, right? Roth is after-tax contributions that grow tax-free. And then someday you take them out under the proper rules and you don't owe tax on it. Okay? Same thing. Your beneficiaries inherit that. So Roth accounts are generally tax-free to beneficiaries, same as the owner. So right now, the only additional thing that beneficiaries have to deal with is in 2019, they added a 10-year limit. So if you inherit a traditional retirement account or a Roth retirement account, you got 10 years to empty it as a beneficiary. You know why? Why would that be? The government wants their money. They want to tax it, right? So that got added in 19. And again, you essentially inherit the same tax treatment as the prior owner, your parent, whoever is listed you as beneficiary.
Real quick.
Okay.
This is I want to point this out. Unless you're the spouse, so if your husband, the wife in this situation, and your husband passes away, you can roll that money from their traditional account into an inherited IRA as their spouse, and that 10-year window does not apply to you. You can still amortize it over your life. You can start, if you're below RMD age, you don't have to take RMDs until you reach that age. You can't add to it, but you can let it sit there. So this is assuming it's dropping a generation down.
Yep.
Right. So we're going from parent to kid is the 10-year rule.
Yep. Thank you. Good clarification. There is an RMD aspect to this. Many of you know what that is. I'm not going to touch on it. It gets a little too detailed for this presentation. Okay, let's keep going. So here's an example. A parent, 65 years old, passed away, had a tax-deferred account worth $100,000. You are one of 2 beneficiaries listed at 50%, right? So you're due to get $50,000 from this account. You could withdraw it all and take it today. For a tax-deferred account, you would owe taxes on that $50,000 distribution as a beneficiary, right? If it's taxed at this level, it's taxed to you. So you could take it all today, pay taxes on it, or you could open an inherited account and have 10 years to have it empty. So you could take $5,000 a year for 10 years and, in theory at least, pay a lower overall tax rate over those 10 years. Is that right, John?
That is correct. And you can do it all at once. You can do all at the end. And you can do it. It doesn't have to be a flat amount. The rule is it just has to be emptied in that 10-year window. So you can pick and choose.
Okay.
Absolutely.
Here's another little quirk. What if your 65-year-old parent had a Roth account worth $100,000? Same thing. One of two 50% beneficiaries. Again, you could take it all today, and you remember, when you take money out of a Roth, it's not taxable. Totally tax-free. That's one of the beauties of a Roth. You paid tax up front, or sorry, your parent paid tax up front to get it in. So you could take it all today, or look at this. You could open an inherited Roth and have 10 years to continue to let it grow tax deferred, and then take it out tax-free at the end of 10 years, which actually sounds like a better deal, right? So there's some strategy here that needs to fit into your situation as a beneficiary. So rely on your advisor. Okay, moving on beneficiaries. Life insurance proceeds to individual beneficiaries are typically tax-free. Huge question. Are life insurance proceeds tax-free? Typically, yes. Annuities are either retirement accounts, which we just talked about, right? Pre-tax or Roth, or non-retirement assets, and they're treated similarly. So nothing new information there. Pensions are really unique because it often determines the selection that the prior generation selected when they retired about how they wanted their money. Sometimes there are survivor benefits, and sometimes, okay? Just a little note on that. Okay, talked about listed beneficiary. Second, joint ownership. This gets a little tricky. I'm going to try to be as clear as possible. Okay, joint ownership can be on anything that you can own individually. Land, homes, real property, bank accounts, non-retirement investment accounts. You can own it individually. You can own it jointly with somebody. And typically, joint is between spouses, right? But sometimes, if you have a single mother, which is the most common scenario, they can choose to name the next generation as a joint owner on an account. And we'll talk about the pros and cons of that. Now, joint ownership changes to single ownership automatically upon death of one of the owners. Okay, pretty simple concept, but we're going to get back to that. Okay, a few tax definitions here. John, you love this. Basis. Basis matters. Well, sorry, basis is what the owner paid for an asset. Very simply. Any asset. Could be stocks, could be bonds, could be real property, homes. So the example is, and we're going to come back around to this later, remember this, a parent bought a lake house way back in the 80s for $200,000. Today, it's now worth $500,000. What's the basis? 200, right? Basis is what the owner paid for the asset. So the basis is 200, the property is worth 500, okay? Now, here's where taxes come in. If this is your mother and she sells it today for $500,000, that's value, $500,000, minus the basis of $200,000 equals a $300,000 gain on that piece of property, right? If she sold it today, a lake house is taxable. So she would have to say, I had a taxable gain of $300,000 this year. Okay, just a little definition on basis. Okay, here's an estate tax definition. Stepped up basis. Under the current rules, on certain property, the beneficiary's basis is adjusted to the value at the owner's death. Okay, let me keep going because we're going to get back to that. So again, this is the spoiler, right? Under current law, the most tax efficient way to inherit is at the owner's death due to the step up in basis rule. Let's keep going. Joint ownership, tax ramifications. I'm going to skip that one. Here's the thing. Let's say your mom, who is single, added you, a child, as a joint owner on the house while she was still alive. That constitutes a gift of half of the value of the house. Okay? And we'll talk about gift in just a moment. Your basis is gifted. So her basis was 200. She gifted this property by naming you as joint owner. Now your basis is 100. her basis is 100. That's how that works, okay? So lifetime gifts transfers the basis. Upon death of the joint owner, so let's say your mom passes away, she didn't sell it during lifetime, but she died with it as a joint owner, it converts to, you're now the sole owner of it. Your half is still at $100,000 in basis. Her half is stepped up to half of the value. You get a half step up in basis on joint property. So what that means is the beneficiary, you now have a total basis of 350, right? 100 from your half, a $250,000 step up from her half, and now that you're the full joint owner of, okay? So $500,000 home, you own it outright, $350,000 basis. Keep going. Downside of joint ownership. If the owner, if your mom simply owned it individually and passed away with it, owned individually, and the asset passes through the will, your inherit, you would still own it, 100%, and you would have a $500,000 basis. Okay? So sometimes joint ownership creates a problem. Sometimes outright gifting of assets creates an estate problem, and we're going to touch on that in a little bit. Farmland story. These families and parents have the best of intentions, but they do something irrevocably that they can't undo, and it creates a huge issue. Huge issue. We had 3 people walk through the door, and their parents had just passed away. Their last parent had just passed away, and they were in line to receive somewhere in the neighborhood of about 1,000 acres per person. Okay, huge farm, big inheritance. I think 1,000 between the 3 of them. Okay, so in a throwaway comment, one of them said, well, yeah, when Dad transferred the farmland to us because he wanted to avoid probate and this and that, and an alarm bell went up. So during life, the dad deeded all the land to the kids to make it easy, right? What he also, when you receive a gift, a lifetime gift, guess what happens? We talked about it. The basis is transferred. What the parents paid for it, now the kids paid for it. And what the parents paid for it was $1,000 an acre. And on 1,000 acres at current value, so their basis is $100,000. That's what they bought the land for back in the 80s. You know what the value is today? $15 million. And guess what that is? That's a $14.9 million capital gain income that you will owe taxes on. $5 million bucks, okay? $5 million mistake done trying to have the best interest in mind. Major, major, major mistakes, okay? So joint ownership should send a little red flag up. Gifting during lifetime should send a little red flag up if you're in the inheriting generation, okay? By the way, they came in thinking, we're going to sell the land, we're going to have all this money to do what we want. Changes the outlook, doesn't it? I don't think, we don't know, because they had a whole new set of issues now, but I don't think the land was sold. I think they just end up keeping it. And probably, hopefully, keeping it until their death, when if the same rules are in place, their kids can inherit it at a step up in basis. Transfer on death. Again, this is essentially beneficiary designations on different property other than what beneficiary being, retirement accounts, annuities, life insurance, okay? This is for individually owned assets.
We'll see these a lot when we work with some elderly clients, on cash accounts, right? Like, and they're very clearly in the title or brokerage accounts. It'll say Susie Smith, and then right below it, TOD John Smith, right? Like that's the designation we'll see here. So it just instantly, as a function of law, Susie passed away, submit a death certificate, the account owner immediately transfers. So not a gift at that point. It's not a gift when this happens.
It's because it's after death.
It's after death.
Yep.
Correct.
Transfer on death. So the step up happens, then the transfer of ownership happens. Example, bank accounts, non-retirement investment accounts, tax ramifications. does allow for a step up in basis because it happens after death. It means beneficiaries can often sell immediately on these accounts with no tax consequence. So the example here is you are listed as a TOD on Grandma's stock account. Way back when, in 1999, she bought 50 grand worth of Apple stock. Today, that's worth 2 million. And because you get a step up in basis, your basis is now 2 million as of the date of death. So you can turn around, sell that, owe no capital gains, no tax due on that transaction. That's the power of step up in basis. And that's why you want to inherit, I should say the most efficient way is to inherit at death, as long as it's done right. Okay, ways to inherit. Will. Who's who in a will? You got the testor, who creates the will. You got, they get to name the executor, right? The witness only is necessary at the signing of the will to make it valid. The testor gets to name beneficiaries, or who gets assets out of the will. And also, if they have minor children, they get to name guardians. If I'm not around to parent my children, who do they go to? Okay, pretty important stuff. Will governs distribution of assets or an estate by the chosen executor. Probate is the execution of that will under court supervision. Okay. Interesting, in Iowa, you must actually have the original will to submit to the court to start the probate process. They won't take a copy. That's why it's important, the I love you folder, to get that original will in there, or often the attorney law firm that you do it with keeps the original. Okay, so track that thing down, know where it's at. Again, if I'm talking to you, or if I'm talking to you as children, make sure your parents have that for you, okay? Probate expectations. Typical probate is between 9 and 18 months. It's just with all the requirements of the court, it's difficult to get done much quicker than 9 months. And estates can stay open for years, honestly, if they have assets that they can't liquidate.
In this, you're at the subject to the court system. So I like to point out, like, rural communities where there's not a probate judge there all the time and they're brought in, that will extend. So if you have family that's in a smaller town where the judge only comes in once a month, it's important to make sure you're ready, have things, because that's what will extend. Very easy estates that I think are easy will take 18 months because you just can't get in front of a judge soon enough. So in a bigger community like Des Moines, we don't have that problem here as much, but think of the outlying communities where, again, you might have one judge that services the entire county and they're only there 2 days a week.
Or might have one attorney that serves the entire county, right? Okay, speaking of attorneys, attorneys can legally charge up to 2% of the estate value, but that doesn't have to work that way. You can, at bigger estates, typically it makes sense to hire an attorney by the hour to help beneficiaries through the whole process, okay? Probate and the wills and the net worth statements and the assets are all public record. I can't say that there's been a lot of people that look it up, but it's out there if you want to see it. And that's one of the things that people don't like, okay? And we're going to talk about that in a little bit when we get to trusts. Intestate succession means dying without a will. And this is a decision tree. I just pulled this up. I don't know if this is Iowa's, but did the person who passed, this is people with no will, by the way, that's 60% of the people that die in Iowa. No will. Okay? Another recommendation, do your estate planning. If you decide on a will, get a will. Know where it's at. Spouse, yes, no. Kids, yes, no. And then if it keeps going down, no. Siblings, no. Grandparents, so basically who gets your property? And this is fine for some people, but I would guess that most people in this room don't want it to go this way. So a will makes it so that you get a say about what things happen.
And side note, this is expensive, right? Because the court system, A, dictates it, and B, you have multiple attorneys involved at $300 or $400 an hour going through this, because they have to go down the line, and there's public notices that have to happen, it gets very expensive. So you could have $500,000 in assets and 50 grand of legal fees if you're not careful, right? To do this.
Famous people that have passed away without a will. Prince passed away. Tom Petty passed away without a will. So, bad news. Okay. Tax ramifications of these two things. Because of the type of property that passes through wills, you usually get a stepped up in basis. Okay? That's the most important part. Okay. Ways to inherit. Trust. This is going to get a little complicated because, well, let's talk first about the parties in a trust. There's the grantor who establishes the trust and adds assets to the trust. There's the trustee who is in charge of managing the trust for the beneficiaries. And there are beneficiaries who, at least someday, will receive assets from the trust. Okay? So, assets are distributed to the provisions of the trust or the instructions. Hey, here's what we want to happen. And the grantor, the creator of the trust, gets to decide those things. And again, there is a wide variety of trusts for all sorts of different purposes. And we're just going to talk maybe about the most popular one that's out there. People in trust can wear multiple hats in a trust, right? I talked about the 3 people. I'm not aware of a trust that the same person can be all 3, but I am aware of trusts where a person can be the trustee and the grantor, right? They can create the trust and manage the trust. I am aware of trusts where you can be the trustee, be in charge of the trust, and be the beneficiary. So you're actually managing it for your own benefit. Yeah. Okay. So here's some tax ramifications of the trust. This is where it can get interesting. Like I said, trusts are widely variable. There's all sorts of different trusts. Some trusts act like an individual and allow a stepped up basis at death. Some trusts, and we just ran across this here professionally, transfer property, remember, and basis during lifetime of the grantor. Okay. I was actually, I guess, a little personal experience. I have been through the process several times, which is why I have a certain passion for it. At the age of 35, I had lost both my parents, and I had lost all 4 of my grandparents. So I had seen this whole thing play out a number of times and actually been intimately involved, in the last step when my mom passed away. So, again, some trusts, it just depends on what the legal structure of the trust is and what it's trying to do. Inheriting from trusts, at least what I've seen, is often quicker than inheriting through probate process and a will. Oftentimes, it just looks like getting the beneficiaries together, going to the attorney's office, and signing paperwork, and getting assets transferred to your name. Okay? It's been pretty, at least I've witnessed it be pretty slick. Another thing that people like, trusts are not public. Inheriting from trust can be exceedingly confusing. So get legal representation and fully understand what a trust means for you as beneficiary. Okay, trust pros and cons. If property is in a trust, distribution to beneficiaries could be many years away, typically associated with ages. So for instance, I'm dealing with a client now, grandmother had a trust with 11 beneficiaries, grandchildren, and they get their first distribution at age 35, which is 50% of their trust assets, and then another 50%, they get the rest when they turn age 40, okay? So again, 11, there's a big age range there, right? So some of those beneficiaries won't be turning 35 for another 15 years or so. So trust can span a long, long time before they distribute.
We also see these on what I'm going to call more complex trusts when we're inheriting hard assets. So think like a commercial building like this that has a tenant. And let's say your parents own this and you're inheriting this piece of property. Well, there are leases. There are things that have to happen in order for and there's probably oftentimes first right of refusal. So we'll see trust. The asset goes into the trust. The beneficiaries now control that asset, but they can't just liquidate it immediately because there are contracts in place. There are other things. So we We see these common when we have hard assets that are illiquid, buildings, real estate, farm ground. And then that's when the timing also comes into play, right? So people have options to exercise. So people don't want to sell it. So they leave it in there. So you never have a liquidating event.
Yep.
So.
And sometimes, because the complexity of trust, trustee relationships, remember the person in charge of managing it, the relationship of the trustee and the beneficiary can sometimes get contentious. And I'm going to talk about one of those here in a little bit. Again, trust pros and cons. Inherited trust assets could be jointly owned with others. John just talked about that. You own a commercial building in a trust, it gets passed along to the next generation. There may be, I guess there may be multiple kids that jointly own one property. It can't be divided up 5 or 6 ways. It's one property, right? The example, another thing that I talked about earlier is owning undivided farmland in the trust, right? The 3 that came in, sorry, that's a bad example, but there could be 1,000 acres of farmland in the trust and 3 beneficiaries. And or less. Maybe there's 180 and they don't want to break it up into 60. So each of them are just beneficiaries. Okay, issues. Here's where it really comes. Issues include illiquidity, differing opinions, and sometimes quote unquote family discounts. This is one of the issues with trust, and we see it a lot with farmland. Number one, let's say there's 1,000 acres in the trust and there's 3 beneficiaries. Well, it would take $10 million to buy out the other 2 beneficiaries. Nobody's got $10 million. So there is no buying out going on. Okay. So you are stuck essentially owning or all selling. Like one person can't sell. Nobody has money to buy them out. So you either all have to sell or you all have to continue to own it. And at that situation, we see spouses of these 3 beneficiaries going like, what? I mean, look at all that money. What are we doing? Like holding on to it and renting it for $200 an acre. That's, in the beneficiary's ear. Also, maybe a neighbor has farmed this farmland for 35 years and this neighbor's renting it for $180 an acre. But the going market rate is $350. And one of the people says, well, I love our neighbor. We ought to keep renting it to him. And the other 2 are like, wait a second. We're giving up a lot of money if we can't sell this and we can't rent it at the going rate. So there's some big downsides to putting property in trusts.
And oftentimes too, in a larger family, you usually have, and we'll use a farm example, right? Like one kid is still farming and that's dependent upon that land, and the other 2 maybe not in the business. And so that you get this dynamic that, hey, I've always had mom and dad farm, like leasing this because they just want the cash flow. Now you got the other 2 siblings that said, I want to buy a house in Florida. I've got kids to go to college. And the one that's farming goes, I can't afford to buy you out. I'm going to keep paying, and I can't afford to pay you $350 an acre because I've structured my stuff at $100 an acre. That's when the fighting happens. And that's very common, unfortunately.
Yeah. Okay. So the most common type of trust that we see is the revocable or the living trust, which acts like individual property, does get a step up in basis, and the goals there are privacy for all parties and avoiding probate. Okay, so that's the typical one that we see and the benefits that go with that. Okay, 6 ways to inherit. There's a couple slides I want to talk about, and we're going to take some quizzes here. So a few notes on gifting. The current tax law says you can gift $19,000 per person per year. Any person to any other person. It's called the annual gift exclusion, and there's no documentation required. Now, that's any person to any other person. So you could give your daughter $19,000. Your spouse could give your daughter $19,000. You could give your son-in-law that's married to your daughter $19,000. Your spouse could give your son-in-law $19,000. Anybody to anybody else, okay? It's a great way to pass wealth. Reminder, gift of assets during lifetime, pass along the basis. So that's why cash is a great gift. to beneficiaries because there is no basis in cash, right? You don't want to give appreciated property as a gift. Yep. Yep. More notes on gifting. Adding a non-spouse joint owner is a gift, right? Remember the example where mom gave you, added you as joint owner on a house? That's a $250,000 gift. Okay, so if a gift is given that is over $19,000, the giver must file an informational gift tax return with their taxes that year. Informational only at this time. John.
There's penalty for not filing it. It's hefty. And it also reduces your lifetime exclusion amount. So right now, everybody's operating in here individually. You can have an estate up to about $13 million, and there's no estate tax. If you give someone $100,000, we're just gonna call the exclusion 20 for easy math. 20 comes off, no documentation needed. 80,000 then needs to get reported on that gift tax return, and that comes off my lifetime exclusion, right? So now my lifetime exclusion is $80,000 less than it was before I gave that $80,000 gift.
All right. Okay, here we are. Here's the quiz part. So what we typically see, right, is in a couple, the husband passes away first. Ladies, you tend to live longer than us. So your wife is probably going to outlive you. So first thing we see is from the husband to the wife. Okay. Say, how is it passed? $250,000 life insurance policy. Let's hear you. Beneficiary. Whoever it says on the beneficiary, we're assuming the husband has listed the wife as primary beneficiary. $450,000 traditional 401k from work. Beneficiary. Again, we assume the wife is listed as primary, but he ought to be checking it. Jointly owned home at death, what happens? Transfers to single ownership in the wife's name, right? Inherited farmland in his individual name. So he inherited 100 acres from his dad. How is that passed? That's a result of how it's passed. But in what mechanism is it passed? The 6 ways, remember the 6 ways to inherit? It's passed through his will. Okay? There's no beneficiary on land. There's no TOD on land. Land could be in a trust or it passes through the will. Okay? So, go ahead.
And a quick little point here. When real estate or hard assets are transferred via some sort of trust mechanism or will, even if it's your primary residence, I'm a fan of having both of these appraised. Some people will tell you not to, that it's not really needed. You'll get it appraised after mom dies. I'm a fan of getting it appraised when the first spouse dies as well, because you just never know what's going to happen with the surviving spouse. And that asset could change use. Like, for example, mom could go into a nursing home. You keep the primary residence that was there and convert it to a rental for whatever reason, right? I want that, and there's an opportunity for a step up in basis on the deceased spouse's half in that scenario. So I'm a fan of getting both of these appraised when the first spouse passes.
Good
Spend
point.
a little bit of money.
Yep, good point, John. So jointly owned, get a half step up in basis. Inherited farmland, get a full step up in basis because it was owned individually upon death, right? And then passes through the will to the wife. Now, it's fairly easy to pass between spouses, okay? It's designed that way. There's a lot less work than when it drops down to the next generation. But let's take a look at that, because the next generation is when mom passes away and their child inherits, okay? So, how is it passed? $100,000 bank account. Will. It could be joint, but it's not. It could be TOD, but there's no TOD on this, so it passes through the will, okay? IPER's pension benefit. Trick question, depending on how she selected her benefit when she retired and started taking income, there could or could not be some survivor benefit, okay? Most likely not. Most of the pension options are lifetime income only for her. trust-owned home. According to the provisions in the trust. 250, Roth IRA. Beneficiary, tax-free, by the way. Here's that home again, pesky lake house. $500,000 jointly owned lake house, jointly owned with the child. What happens? It passes to single ownership, right? And the basis is 350, right? 100,000 for the daughter, stepped up to 250 because the other half passed to death.
And by the way, that scenario with the lake house, imperative that you absolutely have that house appraised when mom dies in that scenario to get that 50% step up. Because let's say you keep that thing for another 10 years and then sell it, trying to go back and determine value at the date of mom's death gets tricky in the court system, right? They're going to say, oh, you can go back and look at sales and things like that. But listen, show me the condition of the house, like prove me it was, so that's where I want, again, imperative to have appraisals done. Spend a little bit of money there.
All right, common misconception, and I hope we've broken these misconceptions today, that a will governs all your parents' assets. Not true, right? Think about beneficiaries. Think about trusts, joint ownership. So, your widowed mother actually wants to give 50% to her child, we're going to say one, and 50% to her charity upon death. So what does she do? Of course, like every person, she goes and has her will written up to say that. 50% to my child, 50% to charity. Here's her assets upon death. You tell me how it goes. Same thing. It's the same example. So, $100,000 bank account. What did it go through? Went through her will. What's the will say? 50-50. Okay, $50,000 each. IPERS pension benefit. Nothing there left. Trust-owned home. She didn't change the trust. Where's it going? Probably to her daughter. Okay? $250,000 Roth IRA. Didn't change beneficiaries. Where's it going? Daughter. Again, $500,000 jointly owned lake house. Where's it going? Daughter. So it did not work out the way the mom wanted. And we see this again and again and again. Oh, I thought my will governed all my assets. No, you got to look at all these things, okay? Another, remember, how to inherit different types of property are passed in different ways with different tax consequences. Here they are. Question. I have 2 more slides on estate taxes if we want to cover, but I want to open it up here. We're getting very close. 12:53. We have 7 minutes for questions. First of all, I want to hear, did you learn something today? Yes? Okay. Is there anything about your own estate plan that you need to change? Or is there any piece of communication that you either need to have with your parents' generation or your children's generation coming out of this event? Okay, think about it. I don't know. Questions? Oh, hold on. Let me take this because we want you to hear. Okay. We want the people online to hear.
Guy, you know better than that. You don't really want them to hear from me. So when you talked about the farmer and giving to the kids and trying to make it easier for them upon death, granted it was more expensive, but is that easier for them at death to have it transferred that way, even though it did cost them more?
Well, yeah, because all this stuff is on paper, right? Transferring a deed is simply going to the local land office and filing paperwork. It did what the dad wanted, but it also made this enormous financial mistake. So, oh yeah. Question? Was there a question?
We were told by the guy that does our taxes that when you get to the end and you sell your last house, you don't pay capital gains tax on that money because you're allowed a one-time home deduction or whatever they call it.
Oh, hold on, John. This is a John Marshall question.
So there is an exclude. everybody has this. There's an exclusion, 250,000 per person. So married filing joint, $500,000 for your gain on your primary residence. So there comes a point when you do a little bit of estate planning, is very common scenario. I've got a retirement house somewhere and my primary residence back here in Iowa. Second residences are always viewed as investments. I sell those things, I buy them at a price and I sell them at a higher price when I'm alive. That retirement house is capital gain. My Iowa house that I paid $100,000 for is now worth $700,000. My first $500,000 of gain is tax free. It's my primary residence. So we do a little bit of planning though to maybe liquidate my Iowa house, and I move full time down to Arizona, right? And then I can maybe, depending on what my gain is here, I might get a little bit of gain exclusion down there as well.
Well, I think the time frame is your primary house for 2 out of the last 5 years.
5 years,
right?
Correct. So there's reasons to sell assets, transfer assets maybe into trust, right? So the answer is it depends, but in theory you are correct. So if you just have one house, then absolutely that's true.
Good point. Another question here.
Okay, when you were talking about a trust and you had a bunch of children, like maybe 3 or 4 or 5 children, and they can't sell it right away, they can't do anything with it, but you made it sound like maybe that would be easier with the will, but I don't see that it would be any easier. You still can't sell.
The will. So trusts can live for a long time. Okay. Wills, our government and court system, generally speaking, unless it's a unique scenario, they want those things settled in 2 years. So the court system and through a will force you to sell those assets or have some sort of liquidating event within a 2-year window for the most part. So if you have a building like this, and unless someone comes to the table, someone says, hey, you know what, we have a pile of assets, we're going to take the building and you guys are going to take the cash, kind of deal. And it's everybody's equal. And that's, so it kind of flows with the intention of the will, if you want to get to that point. Or they're going to say, the court system, hey, you don't agree, I'm going to force a sale here. So that's the problem you run into with a will, is if you have illiquid assets, the court system is going to probably make you do things faster than when you maybe want or should do them. Trust buys you time. There's arguments, but it does buy you time.
All right. What else?
On the 19,000 gift allowance, does that vary by state? Is there considerations we should think about there?
Question is, does that vary by state? No, that is a federal number. Okay. Let me touch here on a couple of slides. Federal estate tax. So under current law, there is a 40% tax on estate values per person in excess of about $14 million. Okay. Now,
and this number is inflation adjusted. So this, in theory, goes up a little bit every year.
Per person. If you're married, it's double that, 28 million roughly. Okay. So if you have combined value that you own as a couple, it's worth more than $28 million, 40% tax on that.
Tax PSA, though, this goes away at the end of this year under our current tax laws. Oh, there we go.
Sunsets, if nothing happens.
Correct.
The current estate tax law sunsets goes down to 6 million per person.
6 to 7 million is what their estimate is.
Okay. And some states have their own estate or inheritance taxes. For instance, as of 1/1/25 this year, Iowa no longer levies an inheritance tax.
Correct.
Last year there was an inheritance tax, but it's gone away. So the prior rules were no tax for after death gifts to those in your direct lineage. Okay. Children, grandparents. Sorry, children, grandkids.
Correct.
However, there was a 5 to 15% inheritance tax paid by the giver in Iowa, or paid by the estate, that's the giver in Iowa, for those other than direct lineage. Sisters, brothers and sisters being the big one.
Yeah. think of what guy's example when the person that died without a will. Oftentimes, this is when that comes into play because usually, if you die without a will, there's a good chance you're probably not married, don't have kids, right? Because hopefully, some of those people. So we see that a lot here. You know, single person dies with $1 million and no direct descendants. That's where that kicks in a lot.
All right. We have come to the end of our time together. It's 1 o'clock. We want to be respectful of your time and the people online that have joined us. Thank you for joining us online. Thank you for being clients and friends of Compass. We are here for you. We are here to help you understand and get through all this stuff in the best possible way. Have a great day. Yeah.